I'm Linda Halloran. I am Town and Country Federal Credit Union's Community Engagement Manager, and want to thank you all for joining us today for this virtual financial wellness workshop on building your financial health in recovery. Over the past few months, Town and Country and folks from Portland Recovery Community Center have been working together to plan this workshop. Both organizations know through our own work in the community the challenges that face people in recovery when it comes to money and rebuilding financial health. And on top of the normal financial challenges recovery brings, the impact of COVID has brought a lot of stress to many people. So no matter where you are in your recovery journey, reestablishing your financial life, planning for the future are all important parts of the process. So we're happy to be working with the Portland Recovery Community Center to offer this session. And so before we get started, I'd like to introduce you to Nicole Proctor with PRCC and ask her to say a couple of words about their thoughts on this initiative. So Nicole.
Thanks, Linda. Hi, everybody. I'm Nicole Proctor, Program Manager of the Recovery Hub at Portland Recovery Community Center. And Linda, as she just mentioned, has been working with us at the center and our members, but also the local recovery community and recovery residences in the greater Portland area on an individual basis. So when Town and Country came to us and was interested in offering this workshop on a bigger level statewide, we were just thrilled to help partner with that.
I'd like to introduce Nicole Lemieux, who is one of Town and Country's longtime employees and someone who has worked with many folks that are in recovery over the last 2 years, helping them navigate some of the financial challenges that they face. And Nicole's going to talk about a range of topics today, everything from new accounts, credit, budgeting, savings, and a lot more. Throughout the presentation, Nicole will stop from time to time to let you post questions on the chat that she, things that you might want to ask more about on some of the things that she touches on. So feel free to post your questions in the chat, and 2 or 3 times during the presentation, we will tune into the questions in chat, and she'll answer some of your specific things along the way. So I'd like to introduce you to Nicole Lemieux.
Thank you, Linda. Thank you, Nicole Proctor, as well. I'm really happy to be doing this afternoon for all of you. This is definitely a subject that I enjoy presenting. I have been doing this since 2014. In the recovery community, and it's one of my favorite parts of my job at Town and Country. So today's presentation is called Rebuilding Your Financial Health in Recovery. Today, like Linda just said, we're going to go over financial health. So that is anything from savings, opening accounts, bank accounts specifically, credit building, credit repairing, and then budgeting. So we will go into a deeper dive of those subjects. Before we do that, I want to just introduce myself again, give you a little bit of background about myself. I have been with Town and Country Credit Union for 11 years, and I'm currently the branch manager of our Forest Avenue location in Portland. I just love working with members and also the community to reach financial goals, dreams, and to be able to educate people about finances. Like I said before, I have been doing these financial classes in the recovery community since 2014. One of my coworkers and myself created a program, and since then we primarily have been visiting sober homes in the greater Portland area and been able to go into the houses and teach this class. Obviously, with the pandemic, that's changed a little bit. So I'm very, very excited to be able to be doing this virtually for all of you. I think it's really important. And like I said, it's one of my favorite things to do. So like Linda said, throughout the program, I will ask if there's any questions. There's the chat option on this program where you can ask your question right there. And I will just pick a couple to go over. And then, of course, at the end of the presentation, there will be contact information attached directly to me. If you have any further questions, you can reach out right to me yourself. But like I said, today what we're going to cover is strategies to regain financial health, account essentials, which really dives into bank account information, how to open an account, what does it mean to have an account, what kinds of accounts, budgeting, which is really important as far as being able to manage debt, building credit, building savings, and then setting financial goals and what that looks like, and how to sort of, set financial goals that are attainable, and that you can adjust according to what could be going on in your life at that time. So the first thing that we're going to go over are strategies to regain financial health. Before I do that, just some examples of financial stress that can occur that sort of get us to the point of wanting to regain our financial health. These stressors can be anything from, depleting your savings accounts, overdrawing checking accounts, borrowing money from family and friends, maxing out credit cards. It could even lead to bankruptcy. So what do people do if they have some of these stressors in their life to regain their financial health? The first thing, in my opinion, really, really important is to be as proactive as you possibly can. And it's never too late or early to ask for help. Reach out to people, reach out to your financial institutions to see if there's anything that they can do to assist you. Creating a budget is really, really important as well. Assessing your bills and your debts goes into that budget. So figuring out, what do I owe? What do I make? What should I pay? What bills do I have is really important when starting to create a budget and also developing a plan to pay maybe some of the items. Reviewing your credit report, I would highly suggest at least once a year, if not more. There's a lot of programs out there free that you can go on and you can review your credit report and really start to dive in and see what's on there. Establishing key accounts, which can be anything from a savings to a checking. In order to be able to pay debts, a lot of times you have to have some sort of bank account. In order to have your direct deposit or your income coming in, you're going to need to have a bank account. So really establishing those sort of accounts to be able to take care of your financial health. Saving regularly is really important, and it can just become a habit. So we're going to dive into a little bit about that as far as, paying yourself first, and also what sort of savings accounts I would suggest having and how to start that process. So when we talk about account essentials, what we're doing is we're talking about bank account information. So checking, savings, credit cards, and of course, in today's day and age, mobile banking. That has become more and more important as most of us know that a lot of this stuff is going virtual, and mobile banking is a very, very easy and great way to be able to really monitor your accounts. And you can do pretty much anything you want right in your hand on your phone. I would encourage you to, open up a checking account if you don't already have one. Typically, credit unions, Town and Country for sure. You can open up an account 24/7. You can do it in the middle of the night if you want, in less than 10 minutes. Usually there's very little fees. At Town and Country, we don't have any fees. We have a very small minimum balance for a savings account, no minimum balance for a checking. And then there's ATM refunds a lot of times, and then some other great things that go along with those accounts. So we're going to dive deeper from here into budgeting. We've set up the account, so now we can start talking about budgeting. So one of the first and most important things to do when starting a budget is to know where you stand. What this means is know what your income is, for number one, and also know what your bills are. So what do you have to pay monthly? I do encourage people to write it out on paper. I think that that's a really good way of seeing it and being able to adjust it. And also knowing that this budget is going to be something that's going to need to change as time goes on. It's not set in stone because things change and needs change. And I think we've learned that, you know, a lot of people used to work in offices and were driving every day, and now they're working from home. And so their budget may have changed a little bit in that they're not using as much gas in their car, but maybe now they're spending more groceries at home. So just knowing that it needs to be adjusted according to whatever is going on. And then last but not least, to prioritize your needs versus your wants. So it's really important when you go into a store and you have a cart full of something, groceries, items, and you look in the cart and you realize, I don't know if I really need this. So really talking to yourself about, you know, is this a need or is this a want? That will help with your budgeting as well. The next part of this presentation is going to be really diving deeper into managing debt and credit. Before I do that, I just wanted to check and make sure that there weren't any questions as far as account essentials and budgeting, that piece of the presentation. If anybody has any questions, you can feel free to jot them down in the chat and I can answer them now, or we can sort of go back to them at the end of the presentation as well. So I'll just give a couple minutes to see if anybody has any questions about anything I've gone over so far. And then we're going to dive deeper into the credit and managing debt. So it does look like we just got one. It's a really good one. So what if your income isn't stable or you make a different amount each week? So that's really good. My suggestion on that as far as budgeting is going to be to look monthly. So really figure out monthly what you are bringing home for income. And if that changes, the other thing to do would be to lowball your income, as in maybe make it the lower months of whatever you're bringing home for income so that you know you'll be able to afford those bills on the lowest possible income that you might be bringing home. And then if there's additional income from there, you can use it to pay additional bills or you can use it to save money. So that's a really good question for sure. The second chance account for someone who had a negative mark on their banking history. This was something I had utilized in early recovery and not all institutions offered them. That is correct. I'm not sure of which institutions don't and which ones do. I can tell you that Town and Country does not. There's a program called check systems. I'm not sure if people are aware of that, but that is a system where if you do owe another institution money on a bank account, they can put you on a list under the check systems. And if you come up on the list, there is a chance you wouldn't be able to open an account at an institution. Town and Country does not pull check systems, which means we do not check to see if you owe other money to another institution. So we do offer accounts to anybody that lives or works in Cumberland and York County. That is just our field of membership. But as long as you can meet the membership, it doesn't matter. We do offer second chance accounts for people. So that was a really good question, and we are into second chances. So it doesn't look like there's any other questions on that particular part of the presentation. So I think what I'm going to do now is dive into managing debt and also the credit, and then I will ask another time during the presentation for questions, more so about credit. So there will be that other time to be able to do that. So start thinking of questions if you have any. So managing debt, this goes into if you currently have debt that you owe and you don't quite know maybe the best way to pay it, or do I pay it, or what do I do with this debt? So my suggestion would be to pay off the higher interest credit cards or loans, whichever you have, first, because then you're going to end up saving money in the long run. It's always a really good idea, if you can, to move revolving debt. When we talk about revolving debt, we're talking about credit cards. Revolving debt is something that you can constantly use. So you use it, you pay it, you use it, you pay it. So if you can pay revolving debt as in a credit card off and put it into an installment loan, that's going to help manage your debt easier. An installment loan would be something like a personal loan, an auto loan, something that has a term and a set monthly payment to it. So if you take, say you have 4 different credit cards and you put that into one monthly payment, it's a lot easier to manage than having to pay 4 different credit cards every month. Refinance any loans to lower payments. So this will help by being able to pay more off every month. If you can get those loans at a lower payment or even a lower interest rate, that will help as well. And I do encourage everyone to look at what their interest rates are on any of the loans that they might have outstanding, because sometimes we don't realize how high our interest rate is and that we can get a better deal. And even if it's a percentage point lower, it's still something. So just really educating on what are my interest rates and can I save money? And then the Snowball versus the Avalanche method. So this is really a preference on what's easiest to manage for someone. There isn't a better one over another, but I just wanted to explain what these are. The Snowball method is a strategy where you pay off your debt in the smallest to the largest, which kind of means that if you have 3 different credit cards and they have smaller balances on them, and then maybe you have 1 credit card with a larger balance, it would be paying off those smaller ones first to get rid of them, and then start really focusing on paying off that larger balance. The Avalanche method is different. It's a strategy where you pay off your highest interest cards or loans first, to try to eliminate how much money you're paying. And like I said, there's not one that's better than the other. In my experience, most of the time members will want to do the snowball effect because it's a lot easier to manage if I only have, 1 payment to focus on rather than 5. So they'll pay off their smaller debts first and then really start focusing on the larger one. But that is something that I would encourage, if you're not really sure what the best strategy is to start out. I mean, it's a good idea to go in and ask your financial institution if they have any suggestions for you. And also, if you're finding that you're not able to manage the debt, it's hard to get ahead. I would also encourage you to contact the lenders and see if there's some sort of payment plan maybe that they can help you with, or even maybe deferring loans so that you can pay those other ones off. There's all kinds of things that financial institutions can do to help. So I would also encourage never to be afraid to ask. And if they say no, well, at least you tried to ask. So I think that's the first step in that process of managing debt. And so we're going to move into the credit aspect of the presentation. And we're going to start with building credit, building and repairing credit. So when we talk about building credit, we want to talk about what is credit, why credit matters, your credit score, and what does that mean to us, credit report. So what's the difference between a credit score and a credit report? And how do I establish credit? These are all things that we're going to go over in the next couple of slides. The first one that we're going to start with is actions that hurt credit. So what is going to affect my credit and what can hurt my credit? So number one, so missing payments is most important. Make sure your payments are made on time. Maxing out credit cards, taking cash advances will hurt your credit as well. I'm going to go over what credit utilization is and what that means. But basically, maxing out credit cards will lower your credit score because your credit report thinks that you're using your credit often, and so it's going to lower that credit score. Closing credit cards can impact your credit score. If you have a long time credit card that you've made really good payments on and then you close it, it's going to decrease your credit score. Opening numerous types of credit in a short time, that's all about inquiries. So every time you apply for something, a credit card, a personal loan, an auto loan, a mortgage, etc., they're pulling your credit report, and that's going to show up as an inquiry. And the more inquiries you have, the lower your credit score is going to be. So that makes sure that when you open something, it's something that you think you're going to use, and that you're not just opening credit cards to get a good deal at a store. Paying debt with debt, that sort of, robbing Peter to pay Paul kind of philosophy is you don't want to pay your credit card using another credit card kind of thing. Using student loan money to pay off debt and not opening or viewing your monthly statements. So that's really important. If you're getting something in the mail, it's really important to just open it up and see what it is. And that's when, if you can't pay it or something's come up, that's when I would reach out to that lender immediately and say, I need some help, and see if they can set up some sort of payment arrangement just to get it paid off or down. So credit scores are similar to letter grades. You can see on the screen that, the higher the credit score, the higher the letter grade. So the higher the credit score, the less you're going to pay. The credit scores are pulled from 3 different credit bureaus. Equifax, Experian, and TransUnion are the 3 credit bureaus that will pull credit. The big thing with credit scores is, just to give an example, if you have a E letter credit score, so a 549 or below, just as an example, your interest rate on an auto loan could be anywhere between 14 and 18% versus a 730 A+ credit score. You're looking at an interest rate on an auto loan anywhere between 3 and 4%. So quite a huge difference of interest, which impacts that monthly payment, but also your overall amount that you're going to end up paying on that auto loan is quite a bit more. So the higher the credit score, the less you're going to pay. And then what makes up your credit score? Credit utilization. So like I said before, payment history makes up 35% of your credit score. So most important is just to make sure you're making those payments on time. Next is 30% with capacity. What that means is that would be a balance versus a credit limit. So that's primarily credit cards. If you have a limit of, say, $5,000 on a credit card, you're going to want to try to keep your capacity at least 30% or under of that. That will help your credit score the most. After capacity would be length of credit history, makes up 15%. So the longer your credit history file is, the higher your credit score will be. So a lot of times when you're starting out, when you're building your credit score will take a little bit longer to start to go up because your credit length is shorter. 10% is new credit and inquiries. We talked about that. The inquiries meaning every time somebody's pulling your credit. If you have a lot of inquiries on your credit report thinks that you're looking for credit, so it's going to decrease that credit score. And that makes up 10% of your credit utilization. And then last but not least, 10% mix of credit. So it's important to have a mix as installment loans, which would be, you know, a mortgage, a personal loan, an auto loan, something that has a term and a set monthly payment is an installment loan. And then revolving debt is also very important, and that's a credit card, something that you can consistently use and pay every month. So that mix of credit is important for making up your credit score. And then steps to rebuilding credit or starting credit. Pay bills on time. 35% is made up of your on-time payments. So that's very important, is to make sure that you're making payments on time. Use only 10 to 30% of credit available on credit cards. That's the capacity we talked about. So making sure that your credit card limit, you're under 10 or 30% of that as a balance. Pay down credit card debt if possible, because if you are over that 30%, your credit score will negatively be impacted by that. So paying down the credit card debt first is very important to rebuilding credit. And then maintain long-standing credit relationships. That's the length of credit. So like I said before, if you have a long-time credit card that you've had, say, 5+ years, and you've made really good payment history on that, and there's no annual fee and there's no minimum fee, it's best to keep that credit card open even if you don't plan on using it. That will hurt your credit negatively if you close a long-time account like that. So just by keeping it open and having it sit there, that's going to help continue to build your credit and keep your credit score as high as possible. Open new accounts only when needed. A lot of times people will open accounts for a deal, and that's fine if you plan on paying that deal off within the month. Sometimes those deal cards, store cards, have an annual fee, which is something that you want to make sure you look out for, because you don't want to pay, you know, $90 or whatever it is just to have a store card. Also, if you're buying something and they offer you 40% off, make sure you pay that balance off by the end of the month, because if you don't and you keep it continuing, it's probably ending up costing you more in interest than that 40% that you were able to save. So just be really aware of accounts when they ask. Sometimes they're good and sometimes they're not. So only opening them when they're needed. And then review your credit report annually. I can't stress that enough. Especially with security and just knowing what's on there. It's so important to be aware of that. That's part of financial health, is knowing what's on your credit. And there's lots of programs out there that you can use to be able to monitor your credit for free. We have one at Town & Country. Savvy Money is what it's called. It's right on our website. It's free. And you can go on there and you can monitor your credit anytime you want. But there's others out there. There's annualcreditreport.com, which is also a free credit report that is offered to U.S. citizens. You can pull that, I think, once a year. I think right now they're actually allowing you to do it once a week because of the pandemic. And that's great too, because that'll just give you what's on your credit report. And it's important to be reviewing that. There's other products that I know most institutions offer. I know Town & Country offers them. There's, you know, shared secured visas. There's rewards visas, as in credit cards. Shared secured credit cards are a great way to start building credit. If you don't have credit currently, it's a great way to open up a credit card secured by your own money and start using that card, making good payments, and then eventually you can go on to a rewards credit card or a regular platinum credit card. And I know that other credit unions and most institutions will offer those products too, as well as Town & Country. Are there any questions on credit before I move into the savings piece of the presentation? because I know credit, there's usually a lot of questions on that. I just want to make sure I stop and we can answer any of those. If not, we can move on and you guys can ask them also at the end of the presentation too. I'll just give a couple minutes for any questions on that.
Nicole, I have one while we're waiting to see what questions pop up in the chat.
Yeah.
Can you talk a little bit about the difference between a soft pull and a hard pull, and how that impacts somebody's credit score?
Yeah, sure. Good question. So soft pull is a pull where you have your credit pulled. For example, a credit monitoring company will do a soft pull. That just means that your credit score isn't impacted by that pull as much. Actually, not at all by the credit services like Savvy Money. There's a couple others out there, Credit Karma. They use the soft pull. It's not going to hurt your credit score because it's a monitoring service. A hard pull means if you went into an institution or you were applying for a mortgage, they would pull your credit within their system and their software, and that would be considered a hard pull. That will lower your credit score. That is considered an inquiry, and that will show up on your credit report as an inquiry. That can lower your score anywhere from like 5 to 15 points, depending on what they're doing with your credit. A soft pull is either none if it's a credit monitoring company, and there's a couple others like insurance companies, and that can be anywhere from like 0 to 4 or 5 points. So there is a difference on whether or not it's considered a soft pull or a hard pull for credit. We'll go on to savings. Which is also equally important. This building savings, going over establishing regular savings habits. We've come up with 3 pretty, I think, great savings ideas here, as in short-term savings, emergency savings, and retirement savings. So short-term savings could be something that you're saving for that you know you really want, and instead of using a credit card to purchase it, you start saving months in advance to be able to purchase that item. A lot of our members of the credit union will open up savings accounts and label them different things, and I know some of our members have like a vacation savings because they know every year they're going to want to go on a vacation. And instead of charging it, they're going to save their money every single week or month or however they want to do it. And so when they go on that vacation, they have money set aside for that. That would be considered a short-term savings account. Emergency savings is another great one to really think about. Emergencies happen, they come up. This could be something like you're driving down the highway and your tire is flat, and now all of a sudden I need to get 4 new tires and it's going to be $600. And so having money put into an emergency savings pretty regularly will help in those times when something comes up. And then retirement savings is also one to really think about. This one I would encourage people to see if their employers have any sort of retirement savings options for them. A lot of companies offer 401ks and things like that, and that's a really good option if your company or the place that you work offers that. So encouraging, to look into that with your place of work. Automating your savings. So this is a lot of people, excuse me, will set it up the day they get paid. They'll have an automatic transfer set up to a short-term savings or an emergency savings or the vacation fund. Some members have Christmas clubs so that they can save all year for Christmas, and then at the end of the year they have $1,000 to go out and buy Christmas presents. So this one is good to set it up, automate it, and then you kind of forget about it, and your budget has then been created weekly or monthly with those savings being put into a separate account. You start to really adapt and go, beyond the savings part. If you automate it, it's easier to just kind of adapt to that. And also, there's never too little amount of savings. You know, if you put $5 aside every week, that really does add up. So even though maybe we can't do $100 every week or $100 every month, don't just not do it. Try to do something smaller that is attainable, that you might just forget about. So even if it's $5, $10, it's a good way to start your savings. And with your savings, it might, you know, go into planning financial future and setting goals. So with the goals section, it's important because goals will give you the right step in financial success. It allows you to kind of reach for something, and it feels really good when you've succeeded. So I would suggest a short-term goal, as in 1 to 2 years. This could be a savings goal. This could be, I want to buy a car, or I want to, you know, get into a better situation financially. I want to pay off this credit card, something that's short-term, it's attainable, and then take the steps to reach that goal. A long-term goal would be something 3 to 5 years, so a little bit further out. Also make sure it's attainable. This could be purchasing your first home, purchasing a car, something that you know you might not be able to do right now, but in 5 years it's attainable. I also encourage people to write them down because it's nice to be able to go back and see them, and when you do succeed, it feels really good to see that on paper. So the goal section is really important as well. Some takeaways. The number one, and I can't stress this enough, is to be proactive and don't ever hesitate to reach out. I think that it can be a little bit daunting to have to reach out to people, but it's really important because that's what we're here for. I mean, especially at Town and Country, I can definitely say I've worked here for a long time, and we definitely get financial challenges. And I feel very strongly, and I know Town and Country does, that you can't move forward without doing anything. And I think the first step to financial wellness is reaching out, getting started. You know, if that means you want to move your account to us, that's great. If it means you have another financial institution that you're working with and you feel really confident about and you have a good relationship with them, that's great too. I think that that's what we do. That's why I come to work every day, is to help people financially, whether that means to open an account, to build credit, you know, anything financial, to start a budget. That's what we do. We help people financially. And I would encourage anybody that you know, yourself, your family, your friends, anybody that you know is struggling financially or just wants to talk about finances, to reach out to us. You don't have to be struggling. Sometimes people will come in my office and just have like a simple question about something, and they'll always say, I wonder if this is a silly question, but I want to ask you. And I love that because it's like, no question is silly. Not everybody is an expert in this. And that's why Town and Country and myself are here, is to be that person for you to be able to set a plan with, start the basics, and don't hesitate to reach out to us, please. I'm going to put my information on the next slide with the questions. Again, I'm the Forest Avenue branch manager in Portland. My email is there and my direct phone number. If you do have any questions at the end of this or later on, don't hesitate to reach out to me. I'd be happy to talk to anybody. So I think now we open it up for questions that I can answer, and we'll go from there.
Thanks, Nicole. Thanks so much.
Yeah.
And now's the time. If you have any other questions, please write them into the chat, and we'll be glad to answer what's on your mind that we didn't, Nicole didn't address here. Somebody asked about, you know, what suggestions you might have for someone that's going through a divorce that kind of help them get back on their feet. Where to start? I mean, what kinds of things to think about from a financial standpoint with approaching that kind of life-changing situation?
Yeah, I think really important is to definitely have anything that you owe on your own as far as debts, or maybe even together. The biggest challenge and the most questions I ever get about divorce is how do I split my finances from somebody else? Because typically, you know, in today's day and age, when you're married, you use your incomes together to purchase things. So how do I go about splitting debts? And I think it's important to have everything, you know, as much as you possibly can out on paper. You know, if you have an auto loan, a mortgage, what's your income like? And bring all of that to the table so that it's just an open forum at that point where we can really start figuring out how are we going to restructure debt. We do a lot of that here, restructuring. It just means you take debts from other places and you just get creative with how to put it together and be able to make it an affordable payment for someone going through a divorce or any other circumstances to that matter. I think also with divorce, typically it's important to have your own bank account. So aside from the credit stuff and sort of that piece, establishing your own account, if you have a joint account with that person, to start establishing that direct deposit and all of that on your own really makes a difference when we get to the budgeting piece and also this restructuring of the debt. It's helpful to have your own account. But I think just asking for help and bringing what you have and just kind of like laying it out, and then we can get creative with what sort of payments will work with your income, and maybe you aren't going to be able to keep the car or something like that, but at least we know when you come first time or over the phone or whatever, however we do that, we know what we're up against and what we need to look at. So it's really about sort of separating debt and restructuring it when it comes to a divorce situation. I saw one, how do medical debts affect credit? That's always a really big question in the classes I've taught. So typically medical is a collection when it's on your credit. It's not usually an account that's open. It's usually that you didn't pay the medical debt and now it's being reported to collections, and that will be on your credit. It does affect your credit score negatively when it first initially hits your credit report. Medical collections typically will fall off your credit after 7 years of being on there. So in some cases, when I look at members' credit and they have a medical collection on there, say from a year ago, that's almost ready to expire, I won't even suggest that they pay that, because in a year or so, it's going to fall off. So 7 years is typically the period of medical debt being on your credit report. After like 1 or 2 years, medical debt typically goes like stale on your credit. So it's not going to hurt you and it's not really going to help you. It kind of just stays on there for a lender like myself to see. When we when we do the decisions of loans, we don't typically hold medical debt against our members. I mean, it's something we look at, and sometimes it can tell us a story if maybe there was something that happened a couple of years ago or something like that. It opens up that door, but it's not something that we're really necessarily holding against members as far as making a loan decision, because it's pretty easy to get a medical debt on your credit. But that's a really good question. We get that a lot. Trying to think, let's see.
Another one about debt consolidation.
Yeah, I like that one too. Is debt consolidation a good option, or is it best to make payments individually? That would be depending on what sort of debts you have to pay off. If you have, say, 5 debts and they all have really high interest rates and you know you can consolidate them into one payment at a lower rate, that's the way to do it. The goal is to obviously save money and also to make that payment affordable for yourself so that you're not struggling to make 5 different payments. If it's not that you're going to save interest and you can make the payments, then I would either do that snowball effect or avalanche effect and start really focusing on paying, one at a time. Like really focus hard on paying more on one of them to get rid of it, and then the next one, and get rid of that one, and then the next one, and get rid of that one, so that you can wrap your head around making easier payments and less payments every month. So I would say that one is probably a preference. on being able to managing all those payments. Or if you're going to save interest, then absolutely you want to consolidate that into a consolidation loan or a personal loan to get lower interest.
Nicole, when is it usually an option if someone has like a car and they want to, refinance that vehicle to, say they're paying a pretty high interest rate and they want to refinance it to free up some money for cash flow? I mean, what's a good rule of thumb about when someone could conceivably refinance a loan like a car loan?
Yeah, so that's going to depend on how much the car's worth, because we only will, most lenders will only loan up to whatever the car is worth. Maybe a little bit more, but not typically. So you can refinance your car at any time. If you went to the, you went somewhere or did a private sale out of state and you got your loan through somebody and the interest rate's high, you can turn around in 30 days and you can refinance it with a local institution or whoever you want. There's no like time frame on that. You can refinance a car at any time. Sometimes it can be difficult if you've gone and you've purchased a vehicle with a really high interest rate, meaning like 15 to 18% interest, and now you're turning around and trying to refinance that a year later. And the reason why it's difficult is because you've been paying so much interest on that vehicle for a year that now your vehicle is upside down. And that basically just means that you owe more than what it's worth. There are ways that we can do that for people. We get really creative in different loan options that we can do. I just did one last week where a member, that was the exact scenario. This member went, purchased a car, got a really high interest rate. It was like 16.5%. He was completely upside down on the vehicle by $2,000, and I wasn't able to refinance the vehicle completely for him. But what we did do is we took the vehicle, we refinanced that into an auto loan at a much lower rate. It was like 8%. And then I took the difference and I did that as a personal loan. And his payment together on those two loans was still less than what he was paying before with just the auto. So there are ways that we can get really creative to make it still work and still lower that payment and interest and make sense to do it that way. But sometimes it can be a little tricky. It's not always clean and easy and quick, but to answer your question, you can refinance a car anytime. There's no like time period that you have to wait.
Mm-hmm. There's another one here about car as well.
Oh, just bought a car, is paying for 1 year and paying off after the year is done a good idea, or should I pay for longer? That's a good question. That depends on what your credit looks like. So if you just purchased a car and that's one of your only trade lines or accounts listed on your credit report, I would continue to pay that loan for at least 2 years. Because that's going to give you 2 years of really good payment history, and that's really important for building your credit score. If you have, plenty of credit, your credit score is good, you've had longevity with your credit and you bought it and you just don't want to pay the interest, then that's not going to negatively impact you to pay that off in full. But if you're doing it for credit building, I would suggest you keep it for at least another year and have 2 full years of good payment history reporting on your credit. Especially with an auto loan, because that's an installment loan and that's variety of credit. And that'll be really good for building that credit score up for sure.
The other thing to think about with that is, to ask yourself about, where you stand with saving. Do you have an emergency savings account established, and are you able to contribute to that? Because emergencies happen. Do you have a short term or other kind of saving that, for the ebb and flow of things that happen in life? So, making sure it's kind of balancing, getting reestablished, paying off the debts you have, saving for, for the what ifs and for an emergency. And so, being able to allocate your cash flow to, make savings a priority, that you're ready for unforeseen things that come up or things that you're planning for. So that might be another reason as to not to try and pay it off in a hurry. If you've got a well-established savings account, that's another factor to take into place too.
Yep, for sure.
Well, we've come to the end of our hour. On behalf of Town and Country, Federal Credit Union, and PRCC, I want to say thank you and enjoy the rest of your day.